So yes, Pyrogenesis Canada Inc., PYR on the TSX, trading right now at a price of about 78 cents with a market cap of about 134 million. So Pyrogenesis designs, develops, manufactures, and commercializes plasma processes and systems in Canada. It offers its Droserite, a process for enhancing metal recovery for aluminum and zinc industries, PureVap, a process to produce high purity metallurgical and solar grade silicon from quartz, and PureVap nano silicon reactor, which is designed to transform silicon for use in lithium ion batteries, as well as plasma torches for replacing fossil fuel burners, plasma arc waste destruction systems for waste destruction, and the company also provides engineering and manufacturing expertise. So as Ryan said, I've covered Pyrogenesis on the podcast back in October of 2022 and in June of 2023 when the stock traded in the $1.06 range. And at that time, I concluded that the company had potential, but to us, the business had yet to validate its business model as it continued to post declining sales and lacked profitability, cash flow, or even adjusted EBITDA. And as I said, someone could speculate on the business, but again, to us at Keystone, the investment case was just too early. So let's take a look first at the financials to see if the company has fundamentally improved from a year ago when I covered it last. So for the last quarter, Q1 of 2024, revenue was up 34% to 3.5 million, but the increase was primarily due to the depressed revenue that it generated in Q1 of 2023. And if we look back to Q1 of 2022, the business actually did about 4.2 million in revenue. Now, net loss was a loss of 4.4 million, or a loss of 2 cents per share, compared to a loss of 6.1 million or 3 cents per share in Q1 of 2023. The company still isn't able to produce positive adjusted EBITDA, losing about 3.2 million in Q1 of 2024, compared to a loss of 5.8 million last year. And as well, cash flow from operations was also a loss of 2.8 million compared to a loss of 6.5 million for the same period last year. So the company continues to burn through cash. And looking at the balance sheet, its cash balance is down to about 170,000 with debt and leases of 10.6 million, providing a net debt position of approximately 10.4 million. So given the business is burning cash, how has it been keeping the lights on? Well, as you can see, the company had a net cash position of 23 million in Q1 of 2021. But over the years, the company has moved into a net debt position. So the company has really been draining its cash balance, has been taking on more debt, and has been issuing more shares. As you can see here with my little chart, now up to 179 million common shares outstanding. And given the dwindling cash balance, debt on the balance sheet, and lack of profitability, I would assume that the company will need to issue shares once again in the near future to keep the lights on. Now, looking at the company's backlog, as at May 2024, it was 28.1 million, which is expected to be recognized over a max of 3 years. And this is down a few million from the same period last year. And because of the lack of net income, EBITDA, and cash flow, we can only value the stock off of revenue, which right now it trades with a trailing price to sales multiple of about 10 times, which is down slightly from the 11 times from a year ago when I covered it on the podcast last. Now, if we did expect that all of the backlog can be realized in 2024, the company would still trade at about 4 times forward 2024 sales. But again, backlog is expected to be realized over a max period of 3 years. So this is likely very aggressive. So at this point, the risk continues to outweigh the potential reward for an investment. And we would continue to classify the stock as speculative, given it continues to lose money, now has a net debt position, and will need to service its debt while it remains cash flow negative, and will likely have to issue more shares to keep the lights on. Now, again, for the Pyrogenesis speculators out there, this is not to say that the stock will not do well over the next 3 to 5 years. And I hope for you that the stock does do well. There could be a significant contract announced and potentially an inflection point in the business's revenue and cash flow. But to us, this is just speculation on what could be. And for our growth at a reasonable price, or GARP investment philosophy, we would not recommend the stock to our clients. Now, this YouTube comment from EE7369 that was posted on my last update a year ago addressed the fact that I mentioned the business model has yet to be validated due to the lack of profitability. And he said that he finds this funny given that by avoiding the stock while it continues to burn cash, we will have missed the major initial run. Now, this is something that we hear over and over and over again. But by building your portfolio with stocks like Pyrogenesis that continue to lose money, take on debt, and dilute shareholders, it's a great way to destroy capital. Like Ryan quoted today in his segment from the Hendrick Bessenbinder study, which looked at 26,000 stocks from 1926 to 2015, 82% of stocks that went up 1,000% were profitable at the start of their ascent. So hopefully that hits home for you. 82% that went up 1,000% were profitable at the start of their ascent. And now just this other comment here to respond to Thoughtful Aquarius. One could analyze a company's qualitative factors for days on end, but at the end of the day, growth and profitability are what drive shareholder returns. And until Pyrogenesis can prove that it's on track to validate the business model and grow earnings per share, we believe that it's a good idea to avoid the business. So yeah, that's my segment. Realistically, I'd say, the fundamentals are just kind of getting worse and worse. I'd say, backlog's down a bit. They're now into, more of a net debt position. And we're really not seeing like cash flow really trend towards that break even point, which, we really like to see. But yeah, now I'll open it up to you guys if you have any comments and whether I just don't understand the technology.
You don't, and you never do. No, so on the balance sheet, something which they did do just on July 3rd was they lowered their warrant repricing, which is effectively them signaling we need to raise money, because normally you would see a warrant like that. It doesn't make sense for the company to lower a warrant if they don't need to raise money. Yeah. It's really just giving away free money at that point. And they lowered it to 75 cents, and it's roughly trading above it. I think right before they did it, I was trading below it. So likely at 93.75 cents, they can accelerate it. So if it hits that point, that is there. We are diluting point. It ended up being, I think, just under $4 million at that point, and that will give them another couple quarters of runway. And that's really just to shave off those warrants instead of just diluting directly on the market at a lower price. And that's really concerning when you're seeing stuff like that. It just means they know they're not going to have the cash flow incoming from their operations. Likely in the near future, they don't want to do any bridge financing with debt or any short-term note and get a better rate. No, they're going to dilute the equity, which is a higher cost of equity than debt. So they're not really expecting that return on company capital at the time.
Yeah, that's a good point, Brett.
Yeah, when we met with management, the story sounded good, but a story is only a story, and until you see actual orders, you see a backlog, then you see that converting to revenues and cash flow. And the company has had minor success in that areas, but in terms of revenue, but nothing close to what would meet our criteria at this stage. And there's no surprise to seeing the stock suffer since it hit those kind of pandemic highs. It just didn't deserve to be there to start, and then now is still at a level at 10 times sales. I think you said, Brennan, that you're building in a lot of future sales in the business right now that aren't there and aren't in the backlog at present to justify the price, even at these prices.
Just even if you're looking at something like 10 times sales, that's what you expect from a high growth software business, not a 20% gross profit business. Even if they've previously been higher in the 40, I think they had a 70% quarter, but I think that had some weird anomalies in it. So, but even if they got to 40%, you're looking at a couple times sales, 2-3 times sales for most companies like that, not 10 times. And even Brennan's generous, it's likely more 10 times sale in reality at this time, not 4.
Yeah. Okay. Well, I think that will close off our segment for the week. I